In recent years, Tesla's stock price has been the subject of a lot of scrutiny, experiencing significant fluctuations that have left investors wondering about its future trajectory. However, despite periodic dips, there are compelling reasons to believe that Tesla's stock price is positioned for another upward surge. There are several factors to be optimistic. In this video, I'll delve into Tesla's financials, which will give you an idea that the company is still performing well, and also regarding Fed monetary policies. At the time of market close on April 30th, Tesla's stock price is hovering around $180. Its all-time high closing recorded on November 4th, 2021 at approximately $410. Despite widespread fear, uncertainty, and doubt surrounding Tesla, investors need not be concerned. Presently, Tesla boasts a market capitalization of $550 billion, placing it 15th among the world's largest market caps. The global tech giant Microsoft leads the pack with a market cap of $3.09 trillion, followed closely by Apple at $2.77 trillion and Nvidia at $2.06 trillion. Tesla's impressive financial performance, combined with its cutting-edge technology, sets it apart from competitors. Tesla remains at the forefront of innovation in the automotive industry. Tesla China has highlighted the durability of Tesla vehicles' battery management system, emphasizing its capacity to prolong battery life significantly. Additionally, Tesla's implemented innovative measures and safeguards to enhance the longevity of its battery packs. For instance, reports indicate that a Tesla Model S retains approximately 88% of its battery capacity even after traveling 320,000 kilometers, which is 200,000 miles. This is one of many positive pieces of news the regular media won't disclose. Also, Tesla has innovation and technological advancements, expanding market presence, energy business growth, positive earnings and financial health, bullish investor sentiment, regulatory tailwinds, so Tesla investors have nothing to worry about. With that said, let's delve into the actions taken by the Federal Reserve. Currently, the interest rate stands at 5.5% and is anticipated to decrease this year. To counteract inflation, the Fed's engaging in quantitative tightening. Let's review the Fed's activities for the month of April. On April 3rd, the Fed has removed $43.5 billion. On April 10th, the Fed has not removed or added anything. On April 17th, the Fed removed $35.1 billion. On April 24th, the Fed removed $3.5 billion. So overall, for the month of April, $82.1 billion. In comparison, the Fed removed a total of $60 billion in March and $45 billion in February and a substantial $109.7 billion in January. This indicates a significant withdrawal for a single month. Ultimately, the Fed will cease quantitative tightening and transition to monetary expansion, likely resulting in a reduction in interest rates. Quantitative tightening updates are very important during any economic cycle. You need to pay attention to this if you're an investor, as this reflects the stock market, crypto market, the housing market, and overall economy in general. Back in September 2022, the Fed announced they're planning to remove $95 billion per month for 2 years. This tactic, known as quantitative tightening, is a contradictory monetary policy implemented by the Federal Reserve to combat price inflation. At a high level, it involves reversing the stimulus measures enacted by central banks following the 2008 financial crisis and the recent pandemic outbreak. By tightening capital markets, it aims to alleviate some of the inflationary pressures. Given the recent surge in inflation rates, the idea of QT is encouraging. However, there's one problem. Implementing QT at this scale has not been done successfully before. As a contractionary policy, it contracts the money supply and puts downward pressure on demand, which could be highly risky for financial markets. This has made many investors nervous, as the last attempt to carry out QT in 2018 had a negative impact on the markets and forced the Federal Reserve to postpone the policy. To understand QT, it's important to first grasp the concept of quantitative easing. QT is essentially the reversal of QE. Quantitative easing involves the central bank digitally creating money and using it to purchase assets, typically government bonds, on the open market. By becoming a buyer in the market, the central bank triggers. As bond prices rise and liquidity increases, the cost of new debt should decrease, resulting in lower market interest rates. This, in turn, should lead to a rise in lending activity as the demand for loans increase due to the more affordable borrowing costs. Banks are expected to respond by lending more money, ultimately boosting overall economic activity. Quantitative easing aims to lower market interest rates to stabilize financial markets. While it typically involves the purchase of government treasuries, the program was extended in the USA to include mortgage-backed securities and corporate bonds. QE was initially implemented in the aftermath of the 2008 financial crisis to address the scarcity of liquidity and support capital markets. It was subsequently extended during the pandemic to mitigate threats to market stability. In fact, the Federal Reserve has purchased trillions of dollars worth of treasuries and mortgage-backed securities over the past few years. While QE has been instrumental in supporting the markets during these financial crises, it's also led to one concerning side effect: inflation. It's important to note that QE is not the sole contributor to inflation, as factors like supply chain disruptions and the pandemic play significant roles as well. Additionally, QE should not be mistaken for traditional money printing, as it generates bank reserves rather than physical cash that individuals use for asset purchases. However, the higher lending activity supported by QE did contribute to an increase in the money supply, which could potentially lead to rising prices for goods and services. This is why, now that some areas of the economy have stabilized since the early stages of the pandemic, the central bank is considering unwinding its balance sheet. While QE involves the central bank creating more money, QT involves the opposite process of withdrawing that money from circulation. This can be achieved by the central bank selling its assets back into the market. However, in many cases, central banks opt for a passive QT approach. This means they allow their debt-based securities, such as treasury bonds, mortgages, and corporate bonds, to naturally mature. When these securities reach their maturity dates, the borrowers repay the face value of the securities to the central bank. As a result, the Federal Reserve's balance sheet begins to shrink. Although the Federal Reserve is expected to continue reinvesting some of this money into new securities, the overall size of their balance sheet will decrease as they gradually reinvest less into the economy. The exact impact of this unwinding process on the economy is not fully known. However, there are some expectations. Firstly, it's anticipated that QT will help with managing inflation. By reducing liquidity, the Federal Reserve effectively removes money from the system, similar to pulling it into a different dimension. This, in turn, should increase the cost of capital and reduce the demand for capital. Since inflation is often defined as too much money chasing too few goods, this reduction in demand for capital can help temper rising prices. QT is likely to increase fixed income yields as bonds can no longer rely on the central bank support to generate market demand. This can lead to a fall in bond prices and a rise in yields, causing longer-term market rates in the economy. This underscores the point that unlike short-term loans, which can be controlled through central bank rate hikes and cuts, there are no explicit methods for manipulating longer-term loans. Therefore, any rate hikes on short-term loans will eventually filter down to influence longer-term rates in the system. Consequently, QT could have a more immediate impact on longer-term debt instruments as they see lower demand. If rising rates and shrinking demand seem like negative indicators, it's because they are. The purpose of QT is a contractionary policy designed to cool off the economy, but it's a necessity to prevent further inflation. The hope is that with the worst of the financial crisis and the pandemic seemingly behind us, there's an opportunity to ease off QE to avoid high inflation. However, like quitting a drug cold turkey, dropping QT too quickly can lead to severe and potentially deadly withdrawal symptoms for those who have become dependent on QE's funds. This is why there are a number of concerns from investors and economists alike regarding the implementation of QT. There's a major risk of a sell-off in the markets. The last time the Federal Reserve attempted to shrink its balance sheet, which is something that very few central banks have done, the S&P 500 suffered a nearly 18% drop from its previous highs in 2018. Investors were nervous about how contractionary policies would affect the economy, but more importantly, QE has been known to inflate prices not only for goods and services, but also for financial assets. With low fixed income yields and more money flooding the system, stocks and even crypto saw higher demand as investors and institutions tried to earn a return with the excess liquidity. Now that the Federal Reserve is reducing that liquidity, this surplus of money might flow out of stocks, which would help explain the 2018 drop and might be a contributing factor to the recent market sell-off following the announcement of the new QT program. Moreover, some economists are concerned that the Federal Reserve may need to actively sell longer-term assets if inflation doesn't respond to the initial progress of the QT program. This could drastically impact the markets further, as the world's single largest buyer of bond securities would suddenly become its single largest seller. To make matters worse, this is compounded by the fact that we've never really done this before. Central bankers do not know what the ideal amount of QT will be, in the same way that quantitative easing was largely experimental. Reversing such a large buying program will also be an experimental process. It's understandable why some people are feeling jittery about QT. We're facing the offloading of trillions of dollars worth of securities onto the economy, and we lack any historical precedent to guide us through this process. No one knows how the market will respond, whether it'll be moderate or severe. However, while the risk of QT to the markets is real, it's important not to despair and consider drastic measures like diving into the metaverse to wait out the uncertainty. QT may or may not cause a recession, and the future cannot be predicted. But there are some factors that suggest we're better equipped to handle QT now compared to the past. For instance, despite high levels of debt and supply chain issues, the economy's in a better position in other aspects compared to when QE first started. Even in comparison to 2018, when QT was last attempted, there's believed to be more liquidity in the system to support the markets. As money's taken out of the system, QT's likely to be done in smaller increments and over a longer duration. In contrast, QE was at times executed swiftly in response to acute shocks. While some anticipate the Fed's balance sheet to shrink by over $1 trillion in the next 12 months, it's still significantly less than the balance sheet growth witnessed during the initial stages of the pandemic. Furthermore, QT will likely be dynamic, with the Federal Reserve monitoring market reactions and having the ability to adjust or change course if necessary. This is not to say that a negative response won't occur or that it won't take time for things to stabilize. However, the Fed is unlikely to continue pursuing QT if it leads to severe consequences. So yes, caution is warranted with QT, but panic is not. As we've seen in previous interest rate hike cycles, markets will eventually recover and adapt. The risks of a recession and market decline are higher with QT, but it's nearly impossible to predict short-term outcomes, and one should be skeptical of anyone proclaiming doomsday scenarios, as they've been doing so for the past decade. There's also a possibility that markets have already factored in this information, so one should proceed with caution in that regard. Nonetheless, it's important to stay informed about the situation and understand what it means when the Federal Reserve announces its plans to unwind its balance sheet. Additionally, it's anticipated that Tesla stock price will experience an eventual increase. The company's consistent revenue growth, improving margins, and positive cash flow indicate a healthy financial position. In conclusion, while Tesla's stock price may experience short-term volatility, its underlying fundamentals and growth prospects remain robust. Despite periodic skepticism, Tesla maintains a loyal base of investors who are bullish on its long-term prospects. With continued innovation, expansion into new markets, a diverse product portfolio, positive financial indicators, investor confidence, and regulatory support, Tesla's well-positioned for another period of sustained growth. As such, investors with a long-term outlook will get the rewards. Thanks for watching. Until next time.